Imagine if you could quickly tell if a company was a cash flow machine or a cash burning dumpster fire. Believe it or not, but you can do that in just a few seconds by analyzing its cash flow statement. But what is a cash flow statement and how do you read it? In this video, I'll explain the layout of a cash flow statement, the key terms to track, and tricks to analyze it fast, all in less than 10 minutes. Hi, my name is Brian Feraldi. I'm a financial educator who's been analyzing and investing in individual businesses for more than 20 years. The clock is ticking, so let's get going. So what is a cash flow statement? It's a financial report that shows how cash moves throughout a business over a specific period of time, usually a quarter or a year. Its primary purpose is to show if a company is producing cash or consuming cash. The cash flow statement answers the question, are you generating cash or are you consuming cash? Like the income statement, the cash flow statement is measured over a period of time. So there's a start time and an end time to the cash flow statement. The cash flow statement can be broken down into three primary sections. There's operating activities, investing activities, and financing activities. Let's take a look at the cash flow statement of a pretend business I made up called Best Coffee Company. Now, at the very top of the cash flow statement is the company's net income. This number is actually borrowed from the bottom of the income statement, which shows just how tightly these two statements are related to each other. Now, once we start with net income, the first thing we have to do is add back any non-cash charges. Non-cash charges could be things like depreciation, amortization, or stock-based compensation. Now, the reason we add these back is on the income statement, these non-cash charges were accounted for in cost of goods sold and operating expenses. But remember, they were non-cash. So since cash didn't leave our bank balance, we need to add them back in when accounting for them on the cash flow statement. The next line item here is changes in working capital. These could be cash movements due to changes in receivables, accounts payable, or inventory. During any given period, these numbers can flow up or down on the company's balance sheet, and depending on the direction, they could be producing cash or consuming cash. Once we add up all of these line items together, we get the total amount of cash that flowed to the business due primarily to the company operating itself. The next section is called investing activities, and this is how the company uses its cash flow to make investments in the business. The most important line item here is something called capital expenditures, which is all spending done on property, plant, and equipment. This could be building stores or paying for furniture or equipment used in the business. The next line item here would be acquisitions, where we would account for any cash payments that we made to acquire another company. The final item here would be sale of investments. So if we sold one of our assets, such as capital expenditures or one of our acquisitions, that would generate cash due to investing. The next thing we do is we add up all of the sources of cash from investing activities, we add them together. The final section is called financing activities, and there's a number of ways that we could add or subtract cash to our balance sheet based on what we're doing with financing. The first major category here is, are we borrowing money or issuing debt that would create cash, or are we repaying debt that would consume cash? The next major category relates to our stock. If a company is issuing stock and selling it to investors, that would create cash, or if the company is repurchasing stock from those same investors, that would consume cash. The final category here relates to dividends. If a company is making dividend payments to its shareholders, that activity would consume cash. Then we simply add up and subtract all the sources of cash due to financing activities. Now, once we've done all that, we take the cash flow from operating activities, we add it to the cash flow from investing activities, and we add that to the cash flow from financing activities. That gives us our total amount of change in cash during that particular period. Then when we add that change in cash to what we started with, we end up with our ending cash balance. And this number goes right to the balance sheet and becomes our new cash balance at the end of the period, showing once again how these statements are related to each other. Now, it's important to understand that not all companies use these exact terms and layouts when they're making their financial statements. In fact, not all companies even call this financial statement the cash flow statement. For example, I've seen the cash flow statement called the statement of cash flows, the financial flow statement, the statement of cash operations, or even the operating cash flow statement. In fact, here is a visual that shows some of the different terms that you might see on a cash flow statement itself. And this is true of all the financial statements, where the terms you might see on them vary greatly from company to company. Now, if you're interested in learning more about these terms, I created a free ebook called Financial Statement School that will allow you to download these visuals so you can understand all the financial statements visually. To grab a free copy of this ebook, just visit the link you see on your screen or click the link in the video description. Now, there's another critical term that you get from reading a cash cash flow statement, but it's not specifically called out on the cash flow statement. That term is called free cash flow. This is the total amount of free cash that a business generates and can be used to reward its shareholders. Calculating a company's free cash flow is fairly simple. You simply take the total cash flow from operating activities, and then you subtract the spending on capital expenditures. This simple calculation will give you the total amount of free cash flow that a company generated during the period. Now, the cash flow statement that I showed you only had 1 year of data for simplicity. However, cash flow statements usually have multiple years of data on them, which can help the investor spot trends. Here, for example, is 3 years worth of financial statement for Best Coffee Company. Now, when it comes to learning how to analyze a cash flow statement, there are 5 key numbers that I look at first. The very first number that I pay attention to is the cash flow from operating activities. This is the total amount of cash that was generated from operating the business. In this case, we see that cash flow from operating activities is consistently growing. The second number that I pay attention to is the company's capital expenditures, or spending on property, plant, and equipment. In this case, we see that this company is continuing to increase its capital expenditures from $1,000 all the way up to $2,000. The next number that I like to focus on is a company's cash flow related to debt. In this case, we see that this business has repaid in 2 separate tranches $1,000 worth of its debt, which means that it's de-levering its balance sheet, which I view to be a good thing. The next number that I pay attention to is the amount of stock that a company is either repurchasing from its investors or issuing to those same investors. Now, the final number that I always pay attention to is in the non-cash charges section. And specifically, I like to focus on how much stock-based compensation a company is issuing to its employees. I want to make sure that this number is reasonable when compared to the company's size, and that it's not over-issuing stock to its employees. Now that you know the 5 key numbers to look at, let's take a look at the cash flow statement of a real company to see these numbers in action. Here is the cash flow statement of Dollar General, a retailer in the United States. The first thing to note is the direction that we're looking at here. In this case, the right-hand side is the oldest data, and the left-hand side is the most recent data. So we're going to be reading this cash flow statement from right to left. The other thing to note is that this company's net income, which is taken directly from the income statement, has actually dropped from $2.4 billion down to $1.7 billion during this particular time frame. All right, with that in mind, let's take a look at those 5 key numbers on the cash flow statement that I teed up before. The first number to look at here is the cash provided by operating activities. This is the cash flow the company generated from operations. Notice that this figure was $2.9 billion in 2022, and this dropped all the way to $2.4 billion by 2024. So the trajectory here is downward. The second number to pay attention here is the company's spending on capital expenditures, which it calls purchase of property and equipment. This figure was just $1 billion in 2022, but it's increased to $1.7 billion in 2024. This is most likely to be money spent on building and opening new stores. Now, with these 2 key numbers in hand, we can actually calculate this company's free cash flow. If we subtract purchase on property and equipment from cash from operating activities, we said that in 2022, this company was generating $1.8 billion in free cash flow, but that dropped all the way to $600 million by 2024. This is a trend that is definitely not favorable for investors. Now, once we know the company's free cash flow, the next number that I like to pay attention to is the debt balance. Notice that in 2022, the company wasn't doing much with its debt, neither issuing it or really repaying it. That changed greatly in 2023 when the company issued almost $4 billion in new debt and it repaid about $1 billion in debt. That means that this company issued a net $3 billion in debt during this period. In 2024, we saw the company issue about $2 billion in total new debt, but it also repaid about $2 billion in total debt. So the company's debt balance didn't change much during 2024. Now, from there, the next number I pay attention to is what the company is doing with its stock. In this case, in 2022, we see that the company bought back about $2.5 billion in stock from its investors. In 2023, the company bought back $2.8 billion worth of stock from the public markets. However, the company did not buy any stock back at all during 2024. Now, the fifth and final number that I pay attention to here is the company's issuance of stock-based compensation. We see that this number was $78 million in 2022, and it declined all the way to $51 million in 2024. Now, $51 million might sound like a lot, but when compared to $1.6 billion in net income that the company generated, I don't view that to be a lot of stock-based compensation at all. Now, like any skill, the best way to master cash flow statement analysis is to practice. But if you can train yourself to watch these 5 key terms when analyzing a balance sheet, you too can learn how to do this analysis quickly. Hope that you enjoyed this video. If so, give it the thumbs up. It really helps us out on YouTube, and I think you'll enjoy this other video I made next.